What is up, YouTube? Stocks by the numbers. Welcome back. Just wanted to do a quick little intro to options video because I know a couple of people may have mentioned they're trying to get into it. They want to learn about it. So I'm just going to go over a couple of the basics here. I'm not talking about like complex option strategies. We're not doing cover calls or strangles or anything like that. We're just talking about, just simply buying a call or a put. In my opinion, I do understand the fact that some people may say, oh, put credit spreads or a strategy like that may be more stable and consistent as compared to simply buying calls and puts. Totally understandable. And of course, if it works for you, just do it. You don't have to explain yourself to anyone, like I always say. But also on the flip side, you may need a little bit more liquidity to do that. You do need several thousand on hand to do that. And if for any reason, any option that you write, which means to sell, if shares get called, you are liable and you have to cover the position and buy the shares. That's why a lot of people, they accumulate a couple of thousand in their account, and then they'll do a strategy like that with a very, very cheap stock, something like a Palantir that's trading in like the mid-teens. So if they do, for any reason, have to cover 100 shares of the stock, it's only going to cost them, whatever, $1,400, $1,500 or wherever Palantir's trading. So, obviously, everyone has different strategies. Everyone has different levels of cash and liquidity on hand. So that's why another reason I like simply buying and trading naked calls and puts. Because if you buy a call for $25 and you're wrong, you can lose $25. That's it. You don't need to have thousands on hand to cover any position or anything like that. And of course, if you're right, your returns could be potentially limitless. And, I've made 2,000% returns on options, which is 20 times your money, by the way. So that's why I'm saying the returns are there and the bets are very small. And even though, of course, it's more risky, that's why you have the potential for greater returns, right? More risk, more reward. But also, in my opinion, I just think it is a very simple, cheap way for you to start to learn the terminology of options and understand how they work and how to put in trades, And again, you can find $10 options if you want, and start with that. No one's saying you got to risk hundreds and thousands of dollars here on your first option trade. But let's just walk through some of it, how it works. We'll try to put in, a simple single order, and I'll just, walk you guys through it if you really never did options before. Of course, the first thing you're going to need to do is get options approval in your account, and I would definitely advise you to try to understand like all this terminology and at least kind of the gist of how they work before putting money on the line. Unless, of course, if you have a really good job and you have really good income and you're just looking for more action. I mean, I can appreciate that. I can understand that too. But again, you try to learn a couple of things before you just dive in. But we're looking here. Let's look at a company that everyone's familiar with. We're looking at Apple Computer, AAPL, and I'm not going to talk about how I called out this wedge and how the pullback was going to happen, and I'm that damn good. Let's put that to the side. You guys probably already know how good I am. But let's just say, hypothetically, we feel that this momentum, this movement, is going to continue, right? Now, we see Apple coming out with earnings in about a month, the end of next month in October, right? So we got about 4.5 weeks to play this position. And let's just say it's going to keep going down, right? Now you got two types of options. You have calls and you have puts. So when you're simply buying a call, you want the stock to go higher. When you're buying a put, that means you want the stock to go lower. So if we're betting that, let's just say Apple's going to pull back to this blue trend line we drew out, and we think it's going to happen, in the next 2 to 3 weeks before earnings, right? Chances are, as I always say, when you do an earnings play, you're probably going to want to catch the momentum of whichever direction, and then, in my opinion, you're going to want to sell before earnings are announced, because I've seen great returns immediately become losses because numbers came out the opposite direction. So very risky to hold through earnings. And also, we know that chances are a company like Apple, regardless of what the market is doing, in my opinion, even if it dips down here, it will most likely begin to rally and run up on anticipation of these earnings coming out, right? So we need something for the next couple of weeks here, 2 to 3 weeks. And I always say, in my opinion, you should give yourself even an extra week or two more than whatever time frame you're looking for, just in case. Because, again, time is better than the strike price. Because if you can't afford, 165 puts with a lot of time, but you could afford 160s, as you see, almost $100 less, that's what I mean. Like, yeah, you're further out of the money and you need more of a drop, but if you're catching the momentum wave at the right time and it's going to keep dropping, well, then this is going to increase in value even though it's further away. And again, I'd rather have 4 weeks on a contract than only 2 weeks, but a little bit of a better strike price, right? But again, that's just my opinion, and let's assume that you have enough money to take the ideal position, right? So first of all, we come over here. I'm using a TD Ameritrade platform just to show you, this trade and some of the terminology real quick. If you're using a different platform and it doesn't look this way, or you're not seeing what I'm seeing, obviously you're probably going to have to pull up a little tutorial on YouTube or something, walking you through your platform. I mean, each platform is different, but, we're going to talk about the main, metrics and terminologies that we need to have to implement the trade. And as you see here, it talks about all the different types of option strategies. You got covered calls, vertical put spreads, straddle, strangles, right? But we're just going to do a single order. We're just looking to buy a put because we think Apple's going down, right? That's it. Let's keep it simple. Action, buy to open to close, sell to open to close, and exercise. So when you buy to open, that means you're paying, right? You're buying the contract. And now you can either sell it to close for a profit, or you can exercise it and actually execute it. And each option contract is good for 100 shares of stock. So if we wanted to exercise this contract, we would have the right to sell 100 shares of Apple at $160, no matter where Apple is trading. So if Apple drops down to $140, we could still sell 100 shares of Apple at $160. And obviously, regardless of, depending on which open position you take, you're going to do the opposite to close it. So when you buy to open the position, you're going to sell to close the position. And if you write the option, which means sell it, write it away, you're going to sell to open and then buy to close. So we're going to buy to open, and we're looking for a put going out again. We said like the middle of October, so we'll give ourselves another week or two. We'll go out to October 27th, and let's say we're looking for that 165 level, right? A put means it's going down, not up. So as we see, Apple is down today a little over $2 right here at this point, and you can see the slight little green ticks taking place in the value of the put contract, because again, as Apple continues to tick lower, it is ticking closer to our strike price of 165. And because it's getting closer to this strike price with time still left on the contract, it is now becoming more and more valuable because it's closer to that value. So right now, some terms are in the money and out of the money, right? So we're betting that this stock is going to drop to 165, but it's still at 170. Which means we are buying this put 5 points out of the money, right? Because if we sold 100 shares at 165, we would lose 5 points per share. So we're 5 points out of the money. Here we would be at the money, and here here we would be in the money by 5 points. So that's basically it. Your expiration, of course, is your deadline, but of course you should use expiration date. You should start learning this terminology. So 165 put out 1 month from today costs a little over $270 each. Now it says 270 by 273. A lot of people think these are dollars. Remember though, they put the option values like this, and each option contract is good for 100 shares. So it's these prices times 100. So as of right now, the bid is what you get for selling it, and the ask is what you pay at market value to buy it. So if you bought it right here at market value, it would cost $274 for you to buy this put. The bid and the ask size, again, just like on the stocks, that's the bid and the ask size, basically, of what's trying to be sold and what's trying to be bought. The volume, just like stocks, that's the amount of these contracts that have traded hands today, almost 1,900 today. Last is the last price. Open interest is, again, see how we're buying to open? That is how many contracts are open right now as of today. Because, of course, some of this volume could be to close some of these contracts. So that's why the open interest changes daily. And we'll go over the Greeks in a second, but I just wanted to go over, some of the main things there. And obviously you have your bid, again, which is what you get to sell. You have your ask, which is what you pay to buy. And the middle price, the mid, is called just that, the mid price. Now, when you come down to actually put in the price to pay for the contract, the main ones you would be using, well, you'd probably mainly be using the limit order, which means you want to put in a price and you want the platform to buy you that investment at that exact price, not a dollar more. When you put in market order, that means it will simply buy you whatever you want at the next available market order, which in this case you would pay $272, right? So a situation like this, I mean, let's say, it was bouncing around for a little bit, but you wanted to get it at a discount, right? You can put in like $265. And, hopefully if the stock ticks up a couple of cents, this will tick down a few dollars, and boom, you can try to get filled at a lower price. In my opinion, when I do options, even if I wanted it right now, I would probably put in like 270 and just wait for it to execute, because I just don't like paying, full ask price, full market value. Of course, it depends on the situation as well. Like if something very positive just came out in Apple and everyone's literally just buying at the market price and it just consistently keeps chunking up, then what's going to happen is if, someone's like, oh, you should buy a call on Apple, you're going to come over here, you're going to type all this stuff in, you're going to pick all this stuff, and then, you're going to be seeing the price just increase in value and keep ticking up. So you're going to put in like 270, and then you're going to go to put in the trade, and it's going to be up like, 274 by 281, and then you're like, oh crap, now I got to change it. I got to change it to 280. And then you go to put the order in, and then boom, now it's up, 279 by 285. And you're like, oh crap, now I got to put in like 290 probably. So that's why a situation like that, again, very, very situational, I can understand if you come to the screen, select an option, and just put in a market order just to buy it, just to get in, just to ride the wave. That is understandable. But again, limit, you can try to get a more of an ideal price, or if you want to be in a situation like this, but hypothetically, I know there's only like 10 minutes to close, but let's just say there were like 2 or 3 hours left, and again, you felt that a little rally could come in, so instead of paying 270, you put in like, 255, because you think the stock's going to rally, whatever, 30, 50 cents, and this is going to start ticking down, and you could potentially get it for a better price. But in my opinion, overall, we are just talking about a couple of dollars. Obviously, if you buy something, if you buy a call right at the open, and then the stock drops all day long, that's obviously going to suck because it's going to consistently go down in value. So, that's what makes timing options so difficult, right? Sometimes you're immediately right, and sometimes you just immediately are in the red, and you're looking at losses, and you're like, oh, I could have bought it for 10-20% cheaper, blah, blah, blah. You go down that whole rabbit hole, right? But again, right here, for all intensive purposes, right, let's just say, so 260, right, 265, that's what I mean. See, 267, 260, so you put in like 270, you try to catch that mid, and boom, right, something like that. It was 3 cents away, right? Did you just see that? It was 267 by 273. So putting in the mid price at 270, I probably would have got filled right there, right? But again, basically, you're betting overall that the stock will pull back, and something like this, you now have 4 weeks for Apple to continue to drop, at least another 3 to 4 points and get closer to that strike price. And then all of a sudden, what you just paid $270 for may be worth $370 or $400, right? And you could potentially make 30, 40, 50% returns on your money just by buying it to open here at $270, and then hypothetically in 2 weeks you come back and now you sell to close the position for $370, right? So again, just walking through what a lot of this means, and I'm sure, again, your platform may look different. I am not familiar with every single trading platform, so I probably will not be able to tell you where to go or how to get there or something. So, like I said, something like TD, I know it's popular, even though some people may not use it, but TD, pretty straightforward. There's like a trading tab at the top, and when you click on it, it gives you like sub-tabs underneath that, and you can select, do you want to trade stocks, do you want to trade options, or do you want to trade mutual funds? And that's what I mean. So a situation like that, you would go to trading, and then you would go to options, and then you would get something like this, and you would have to put in your symbol and your expiration and all that rest of the stuff. And here, this is Investopedia, and I'm going to put this link in the description because I'm not going to go into, some crazy details as they do in this article about the Greeks, right? You guys, you can simply just read through this, and you can even, that's why I want to put the link in the description, because you can, even bookmark it and go back if you need a refresher to remind you what everything is. And as it says here, option Greeks are financial metrics that traders can use to measure the factors that affect the price of an options contract. The main Greeks are delta, gamma, theta, and vega. You can use delta to determine how much an option's price will change for every dollar that changes in the price of the underlying asset. So what that means is a situation like this, right? The put is going to be negative, as you see, and if we switch to the call, see how the delta is positive, right? So if we switch back here and we're looking at the put that we were, let's just say we bought it just now at 270, right? So hey, look, we're up $1 or $2, but you can see it has delta of 31 cents. It shows. So what that means is, for every dollar that Apple share price drops down, this value is going to increase by 31 cents. So right now, if Apple drops to 168.84, this is going to be worth, 305, around there, right? So you'll be up roughly $30 for every point that Apple drops down. And also every day that passes, it's going to lose value as well, which is one of the other Greeks that we'll get into called the theta. But it says here the gamma indicates how much delta, right? We just looked at the delta, how much the option contract moves for every dollar the stock moves. So the gamma indicates how much delta will change when the underlying asset price changes, right? So you got the delta, and then you got the gamma, which tracks the delta, right? The theta measures the daily drop in an option's price as it nears expiration, as long as everything else remains the same. That is what's known as the quote-unquote theta decay that you hear about on so many other videos and in other discords and whatnot. So that's the theta decay. That's what the theta means on an option contract, right? So over here, we have 4 weeks left on the option contract, and it's not showing it to me, but let's just say the theta is like, minus 0.15. So what that means is this option contract is going to lose $15 every day moving forward, right? Now, obviously, I can appreciate the fact that that sounds like a negative. That sounds like a very bad thing. But again, the less time on the contract and the further it is away from the strike price, the less it'll be worth. So if Apple maintains 170 or happens to go higher as days pass, this put is going to lose value because A, the stock price is going further away than our strike price, and B, every day that passes, we are hitting theta decay and we're losing whatever, $9, $12 a day on the value of the option contract. So ideally, which is very hard to do, but ideally, right, a situation like this, you would want to buy the put and have Apple consistently dropping, like 3 of the next 4 days, 4 of the next 5 days, dropping down to like 166 or something, and then all of a sudden this would be worth probably like 400 and change, and you can buy it for 270 and sell it for 400 plus. That's what I mean. That's why it is a trader's market, and you do have to be really sharp and in and out with these options. So if you're a guy who can like just check your account like once a day for 10 minutes, you really can't do options. And if you do options, you're going to have to buy them 1-2 months out at least with time, or potentially even yearly options, and it's just going to be something that hopefully you catch it at a good price one of those days when you check your phone and you're able to sell for a profit. So that's why options traders, if you talk to someone who really does well doing options trading, they don't leave the computer. I promise you, when I was making my money, I did not move from this spot. Literally gave myself an ulcer waking up at like 7:30 in the morning, sitting here drinking nothing but coffee until 4:30, 5 p.m. even after earnings plays and whatnot, and the whole market subsided. So I literally burned a hole in my stomach from just drinking coffee and not eating and not moving, sitting here in this spot for like 9-10 hours straight. So that's what I mean. That's why they say, like, how bad do you want it? Like, yeah, that sucks. But also at the same time, I can reverse an ulcer if it doesn't get too out of control. And if you tell me I made, tens of thousands or hundreds of thousands of dollars during that time frame doing it, you might say it's worth it, depending on your situation. But obviously to each their own. But again, options, they really do move, and that's why it could really get ugly in a hurry. So you may have to just, cut yourself loose and take a loss, or you may have to, be confident knowing that it's like some fake pump, and now you have to double down on your puts because you think in the next day or two it's going to all reverse and stuff. It's very psychological, and again, it's very, I don't even know the word I'm looking for. It's very absorbing. It's very absorbing. So it absorbs, again, all your attention, all your time. That's how you have to be a good options trader. So, but anyway, going off on a tangent here. But yeah, I mean, that's basically it. What else did we talk about here? Right, we spoke about theta decay, and here you have the Vega. The Vega helps investors understand how sensitive an option is to major price changes in the underlying asset. So that's why this is actually a really good article, because it continues to go on, and they talk about the minor Greeks as well. And they have charts and stuff here where the charts, see how they show you how the theta increases, right, days after putting the trade in and whatnot. They talk about, right, gamma is smallest for deep out of the money and deep in the money options. Gamma is highest when the option gets near the money. Gamma is positive for long options, negative for short options. See, we're breaking down all these tables. It's showing how the delta and like the theta changes over these different strike prices and whatnot. So that's why I'm just going to put this link in the description. I'm not going to go through this entire page line by line for you guys, because again, that probably, in my opinion, is not the best way for you to learn it. And that's why I said, giving you the link, and now if you want, you can bookmark it and you can save it, and you can go back, when you have a moment, maybe after hours or on the weekend, and you can teach yourself these Greeks and this terminology and just be that much more confident going into your first, second, third options trades. But I'm going to end it there. So once again, this is Stocks by the Numbers. I want to thank you guys for stopping by. If you have any questions, comments, or concerns, drop them down in the comments section. I'm usually very quick to reply. Like the video, thumbs up, algorithm helps me get more eyes on the channel. But again, this was just for a handful of you who wanted to view it. If it happens to blow up and direct some people in a better, more confident direction, then of course, I appreciate that and I'll take that. But basically, subscribe to the channel, right? That is our handshake agreement. That's what I mean. I don't mind, defining some of these terminologies for you. I don't mind, looking at a position and telling you, just me personally, how I would play it. I updated on, companies like SoundHound and Nikola, talking about like certain key levels to watch. I'll bring you guys Campbell Soup, right? Did a video on Campbell Soup a while back. That's what I mean. I'll look at all these random companies. You guys can come in the Discord. If I think you got to buy puts on the Dow now, I'll give my slant. I'll give my opinion. You guys could potentially try to make a couple of bucks. No problem. Do me a favor, though. Handshake agreement. That's all I ask. That is how you help me help you. You subscribe to the channel. But moving forward, more importantly, like I do always say, I understand that markets are rocky, they're volatile, they're very uncertain. So I want to wish all of you success. Hope everyone makes a couple of dollars. Thanks for stopping by. I'll catch you in the next one.